And, kind of one of the things that Paul Peoples, I heard it from Paul, I'll give him credit. One of the things that, the people that go buy these deals, especially like your first deal or your second deal, you go buy a 50 unit deal or 100 unit deal and think you're going to own it for the rest of your life because it's so great because you've been doing single family, but people own apartments in dog years, right? So every year of real life feels like 7. And the smaller and older the apartment is, the more true that statement is, because this is tougher to run and operate. Because usually when you get into these deals, one or two things are going to happen. Either you hate it, you're like, man, this sucks. I don't want to do this. Let me sell it and get rid of it. Or you love it. You're like, man, I can't wait to sell the small deal, do a bigger deal and scale up. But, at the end of the day, you're likely not going to own this forever.
Hey, everyone. Welcome back to the Get in the Cashflow Game with K&K Podcast. Today, you're only getting K, but we have a really cool guest on. We have Michael Becker on the podcast, and Kenny and I have been following him for at least a couple of years now. So we were introduced to him, or we got to know him through a friend. He is a host of another podcast as well. It's called the Old Capital Podcast. They are actually lenders out in the Texas area. So he's been hosting that podcast. He is also a syndicator for SPI Advisory, and he's been doing that for over 8 years. He has over about 10,000 units in the Dallas, Fort Worth, and Austin markets, or in Texas in general. So very experienced guy, really good company. And we've been following him for a while. He also just launched his own podcast called The Michael Becker Show. So check it out. He's got a lot of very interesting people who have been in real estate. Most of them are local to Texas, but there's a couple of really cool episodes that I personally listened to. He had one with a guy that was an attorney that was originally from California, relocated to Texas. Hearing his story was really interesting. So he's got some good stuff on there, but you definitely want to stay in this podcast and check it out. So prior to SPI Advisory, Michael Becker was also a commercial lender. He worked at Wells Fargo for several years, and that's where he got kind of his experience in multifamily in general. Towards the end of his stay at Wells Fargo, he also was just focusing primarily on multifamily assets. So he is born and raised in Texas, went to University of North Texas. And so he's really an expert on all things Texas. And part of the reason we really want to have Michael on is to just kind of understand this whole syndication thing. I think a lot of us are sort of enamored by it and kind of want to know what the role is, how it works. Also, there's a lot of capital out there. So a lot of our listeners, as well as just people in general, maybe own businesses or they have a lot of capital sitting on the sidelines. They want to invest, but they don't know where to invest. So you can invest with people like Michael Becker, who have experience in the market, have a ton of relationships that they've built over the years. They've got a solid reputation for performing and doing well. So brokers are bringing them their off-market deals and their best deals first. So it's a good vehicle for passively investing when you don't want to do all that work yourself, or maybe you want to save some money on taxes and you can't find a property yourself. You could certainly invest passively and still get all the benefits of owning real estate. So stay tuned and listen in on our conversation with Michael Becker. So Michael, can you just kind of tell us how, your background and how you ended up with SPI?
Yeah, thanks for having me on for the first place. So Michael Becker, I'm based in Dallas, Texas. A company I run is a company called SPI Advisory, and I have a partner named Sean Mabrak. So Sean's in Austin, Texas, and I'm based in Dallas. And so those are the two places we have offices and the two places that we focus on for buying multifamily deals. And kind of prior to going out on my own, I was a commercial real estate lender for a long time. So I was loaning money to other people, and kind of through that process realized I was on the wrong side of all those deals. Kind of better be the borrower than the lender. And so about a decade, I guess now, started buying real estate for investment. So I started like a lot of people do. I started with a 3-bed, 2-bath house in Mesquite, Texas, which is like an eastern suburb of Dallas. I think I paid $75,000 or $76,000, something like that for it, and put $10,000 to $15,000 of work in it and rented it out for $1,100. And then I ended up doing 16 rent houses from 2010 to 2012, something like that. Realized that wasn't very scalable, so went out and kind of reflected what I did all day, every day of work, which is loaning on apartments. And did my first multifamily deal in 2013. It was a 120 unit deal built in the early to mid 70s, kind of C-class deal. I think we paid 3.8 or 3.9 million dollars. So, you do that math, it's kind of like high 20s, low 30s a door. And then we sold it a few years later for 55,000. And the next guy who bought it from me sold it for 80,000. I think it's worth 100,000 or something like that today. And, kind of 10,000 units later, here we are, done over 10,000 units on about 6,000, a little bit over that today. And Dallas, Fort Worth, and Austin are kind of the two markets. So besides that, I'm the co-host of the Old Capital podcast for the last 6 years, and just launched a new show called the Multifamily Investing Show with Michael Becker. It's on YouTube and iTunes and Stitcher, and probably anywhere you hear my voice. That's kind of the new thing I'm doing. So appreciate you guys having me on today.
Yeah, we listen to both of those shows, by the way. And when people come to us asking about like multifamily investing podcasts, because it feels like there's not a lot out there. I'm sure there are, but we always recommend Old Capital, and now we recommend your new show as well. So
yeah, thanks. Yeah, when we started out 6 years ago in the Old Capital, I used to joke we had dozens and dozens of listeners, and now we're getting 40, 50,000 downloads a month. So it's kind of amazing to see kind of how it grows over time. So appreciate you guys and your show, and looking forward to today.
Yeah, congratulations on all your success. It's super cool when somebody jumps into the real estate game and they have all that success, because I know not everybody does. So congrats on that. Quick question for you. So obviously we're in 2021, 2020 started off good, and then we all got blindsided. So I kind of wanted to see your view looking back, and I've obviously watched a lot of your shows. I've heard kind of through the whole, as we were going through the whole cycle. Where do you kind of see everything, and what's your thoughts as you kind of been able to kind of breathe a little bit and look backwards now?
Yeah, honestly, we probably had a record year in the first 2 months of 2020. I mean, it was an absolute monster start of the year. We sold a couple deals. We bought a deal. We refinanced a deal. We had another deal that we helped another guy buy for a fee, and then we had 2 properties in escrow that we're gonna sell. That we got kind of in contract pre-COVID, and then overnight everything just kind of shut down. So it was kind of full force when it kind of went from, I felt like we were going 100 miles an hour, and then we went to zero. It was like immediately. So it was an interesting time, and we kind of basically sat at home and hibernated for about 3 months here in Texas, and come June and go back to the office and start kind of doing deals together. And we bought another deal in August. I think it was the first deal we did kind of post-closing, and the 2 deals we had in escrow that both blew up that we're going to sell, we got them reset and sold in the 3rd and 4th quarter of 2020. And we ended up buying 2 other deals. So I think we bought 3 deals post-COVID and actually closed on 1 yesterday. So I think the market, a lot of this answer is probably going to be very different. Like someone like the 2 of you guys sitting in San Diego, your view of the world is completely different than the view of the world from a guy talking to you from his office in Dallas, Texas. I mean, it seems not that it's normal, but it seems for the most part it's been relatively normal-ish for the last 5-6 months, and kind of most people started getting out of their houses and going back to the office. At least the early adopters around June, maybe May, or maybe I was kind of towards the front end of that curve, I think. So it's kind of day-to-day life's relatively normal. I can go to dinner and I can go to a bar and do things like that, where I think that's still largely not very available to you guys in California. And then what we've seen in our markets that I've been coming to, I mean, we've been seeing tremendous amount of growth and population growth and job growth and corporate relocations. A lot of people from your backyard or maybe just a little bit to the north of you in LA County, and then in Austin where my partner is, and we own a handful of assets. We see a lot of people from Silicon Valley come down there quite a bit, and those trends that have been going on for the last 15-20 years really just have been kind of accelerated a lot of ways. And I mean, Austin real estate is Austin and Phoenix, I think, are probably like the 2 hottest markets in the entire country right now, and it's just unbelievably competitive, and Dallas isn't very far behind. So we're real bullish. I think a lot of this stuff, a lot of these deals are really, if you were to buy a deal and set it in like on a late March and April, some of those deals that were about to trade that kind of blew up, you probably got a 3 to 5% discount, I would say, on pricing for about a 2-3 month period. And once June hit, it was right back to the old pricing. And then ever since June, it feels like, as I'm talking to you right now, pricing is accelerating in real time. Cap rates are compressing in real time. it just feels like everything is getting more and more expensive right now in Dallas and Austin. And I think many places like Phoenix, Atlanta, Carolinas, I think there's similar kind of the Sunbelt markets are all accelerating as we record this right now.
That's what we're seeing here too. And I think for us in San Diego, it has to do with a lot of, like, there's really no inventory either. Do you think that that's kind of what you're seeing as well in your markets, is that the lack of inventory and low rates?
No, it's different because one thing that about Texas, Dallas in particular, Austin's got a little bit of topography, but Dallas is flat and goes on forever, and it's really easy to build. So if you look at kind of like the new multifamily units or even single family units, for that matter, we were consistently number one or number two for about a decade, kind of neck and neck with New York City. And, we were about half the size of New York City when that whole thing kind of started. So we like to build apartments in Texas. So I don't think it's necessarily a supply thing. Maybe a little bit more in Austin, but right now Austin, so Dallas-Fort Worth, we have approximately 800,000 market rate apartment units. Austin has approximately 200,000 market rate apartment units, and Dallas-Fort Worth, year over year, they've been delivering, 20 to 25,000 units every year. Been delivering. Austin's been kind of delivering, kind of a little bit more peaks and valleys, so kind of bouncing between, 4,000 ish on the low end to 8,000 on the high end, and right now they have like 19,000 under construction, so they're probably going to be delivering, 5 digits, 10,000 plus a year. For the next several years. So as a percentage of the base, they're one of the largest supply markets in the entire country, but for good reason, because there's so many people and jobs and everyone's kind of relocating there that, they need to build that level of housing stock, or it's just going to turn into San Diego where it's really hard to build. And you have, so many people that want to be there that just drives the housing prices up. So we're seeing the prices kind of really grow, but there is supply coming. So I don't think it gets quite as crazy as probably what you guys experience at home in either of our markets.
What's your today, like what's your focus on your business? I know last year was a little different, but are you kind of like back to normal, or is things still slowly, or?
Yeah, it's more, right? That's what we're trying to grow and expand. We just bought a deal yesterday as we record this, have another one closing end of the month, and then we're actively trying to place a 1031 exchange for one of our clients, and then probably do another syndication as well. So we're really concentrated in Dallas-Fort Worth. We have 4 assets, about 1,400 units in Austin. Love to buy more in Austin. I'm going to Austin next week to go tour 4 or 5 deals. It's just really hard to make the math work in Austin. And so we're actually probably in the process of looking at maybe expanding to a third market. And to us, San Antonio seems like probably a reasonable market. It's one of the 4 majors in Texas. It's an hour and a half from downtown Austin, downtown San Antonio, just kind of down the street from where we're at. And it seems like that is a market that is about the same size as Austin, similar number of units, similar number of people. But what San Antonio had a lot of supply over the last 7 or 8 years, right? If you look at the supply stats, the same size, same base, there's about somewhere between 5,000 and 6,000 units under construction. So they'll deliver 3,000 to 4,000 units in 2021 compared to Austin. That's going to deliver 2.5 to 3 times the number of units. So it seems like it's probably a reasonable moment in time to kind of enter that market. And San Antonio is no Austin. It's not dynamic with the high growth and the tech jobs. It's kind of more a blue collar city. So it's not quite the same sexy. You don't want to go, unless if you have kids, you go to San Antonio, go to the Riverwalk. But you want to go have a nightlife, you'd rather go to Austin than go to San Antonio. But that seems like probably a decent market, and then try to grow. And we're hoping to do 250-300 million in transactions this year. Probably translate to approaching 200,000. 2,000 units, kind of maybe 1,800, 2,000 units, somewhere in that ballpark. And we pretty much have sold. When we started out, we did a lot of like workforce housing. Was really kind of what we started with. So Texas, think like 1960s, 1970s, kind of for the year of construction. We then transitioned to a lot of B class, so think kind of like 1980s generally for year of construction. And then what we kind of focus on today is really kind of 8A minus. So generally speaking, stuff that's kind of 20 years or younger, year 2000 or newer. And that's kind of the bulk of what we do. And we think that's kind of the best part of the marketplace. And so we've pretty much sold all our workforce housing. We have maybe 3 deals I think left that are kind of just legacy deals that are, well located and always do really well. So those are kind of the last survivors of that era for us. And so we're kind of just trying to, it's exciting to buy nicer, prettier, bigger things. And we think it's, kind of the better part of the marketplace from our perspective right now.
Yeah, because one of the things I noticed, I mean, you guys talk about, a lot of other people, is that from the C's to the B's to the A's, that cap rate's really shrunken down. And so, if you're looking at a CDNA, it doesn't really make sense. Do you think, I mean, because I know nobody knows, but do you think we were going to see a little pressure because people are not going to be able to have to get bailed out on the workforce housing? They might have over leveraged, or they got the bridge loans, or a bit off more than they can chew. Do you think you'll see opportunities there, or do you think you're going to stick more in the A and B class?
I mean, I think potentially that's kind of what I thought. If you would have talked to me about a year ago or 11 months ago, I would have thought for sure there'd be some more pain that would have been felt, in particular in that part of the market. And, listen, like we've had some elevated collection loss and delinquency that versus a normal environment, in any given month, we'd have, less than 1% delinquency historically. And, for most of the first kind of several months of COVID, like 1% went to say 3 to 4%. And then we kind of peaked out in December around 5% in my portfolio. And that was December is usually historically your highest delinquency month anyways, with people prioritizing buying Christmas gifts for the kids versus paying rent. And then now we're kind of in February. We've seen January and February, that collection number as delinquencies come in, so it's not accelerating, it's getting smaller. So that's a positive trend. And then, now there was a $900 billion stimulus passed in December, and within there was $25 billion for rental assistance. And and every state's a little different. So I know California is going to be different than Texas. The states are administering it. And in Texas, they're rolling it out next week as we record this. From what I understand, they'll pay up to 12 months of back rent and 3 months of forward rent for anyone that's kind of delinquent. So we've been carrying, some of these people 3, 4, 5 months of rent. It's a relatively small percentage, but 3, 4 months of rent at $1,000 rent, you're getting, $4,000 delinquent, and the collectability we thought was zero on that. And now we might get some magic money from the government that's going to kind of be a windfall on this delinquent stuff and kind of take the next 3 months forward. And I think I heard in California, they'll allow you they'll give you 80% if you forgive the debt. And I think they'll give you 25% if you don't.
Yeah.
So everyone, of course, is going to take the 80%.
Yeah.
But that's gonna save a lot of these people that are kind of maybe over levered, and maybe we're kind of getting a little bit towards the end of the rope. Because in my portfolio, and I think everyone I talk to, the delinquency that is there is more concentrated in the workforce housing, which makes sense because those people that live in those types of properties tend to have to physically go to somewhere to work, wait your tables, work at a hotel, whatever it is. And those jobs were, disproportionately impacted at a greater percentage than like you two of you guys and me. We just sat at home and worked for 3 months and then get back at it. So that makes sense. So it might not be as bad as I initially thought, but yeah, people in the higher crime areas with the bridge loans, they're certainly hurting. I'm sure their pro forma is going to be just blown out of the water because they're going to have a tough year or two. If you bought something in late 2019, it was pretty tough timing for that product for sure.
Yeah. Speaking of money and the Feds, obviously these crazy low interest rates. One of the things I was going to ask you about, which was cool, is listening to your guys' podcast, and I noticed a lot of guys were locking in on these 10-year loans, and they were like, "Oh, we're going to keep the property," but then they realized they never keep it. And I follow JP Conklin too, so he did that whole survey of that big owner and said they only kept properties 3-4 years and they're paying massive amounts of prepays. And so I think you guys, because the rates are lower, I was going to ask you, I know you're kind of moving into a different type of debt. It's like, and you're using like a cap on that. Can you kind of talk about how that's changed and why?
Sure. Yeah. So when we first started out, we thought we're geniuses, and we started buying these deals, and our interest rates were as low as possible, and they were about 5%. And that was much lower than what they just recently were. And we had a whole year of interest only, and that was great. And we thought we would just lock this loan in. And these loans, these Fannie and Freddie loans, were assumable. So we thought that we'd get, below market interest rate. And when we would go like a couple years down the road, sell it, the next person would want to come assume my mortgage and take it over at a below market interest rate. And the exact opposite happened. 1 year, 5% turned into 4%, turned into now about 3%. And then 1 year of interest only turned into 3%, that turned into 5%. And when you do these large commercial mortgages that are fixed rates, they securitize them. So they kind of sell them as like a bond. So if you invest in the bond fund, you buy probably have maybe one of my apartments that I pay mortgage on every month is somewhere in that bond fund. And so they have yield maintenance or defeasance prepay. So these really large prepays that, if I have a 5% rate and today's rates are 3, if I pay my mortgage off that say it's a $10 million mortgage, to get that same equivalent yield, you have to get, much more dollars to get that same gross yield. So your prepay goes up and is really large. So we've, of the mistakes, unfortunately, we've never made any like life, or critical mistakes where we lost money or anything like that. But, of the mistakes we made, that's been the single biggest mistake, which is kind of mismatching and not really taking into account the yield maintenance or defeasance. I mean, to the tunes of tens and tens of millions of dollars across my career. That's really been a lesson I learned really well. So a few years ago, we started doing a lot of floating rate debt, going kind of alternative Fannie. There's the Freddie floater has been extremely popular. So you get a 10-year loan, but it's an adjustable rate mortgage. And so we started doing that a few years ago, and that's been a really attractive product. Still pretty attractive today. Not quite as good as it was, a year or two ago. And that's been something, and with some LifeCo loans and some bank loans and things like that. So I'm not opposed to getting fixed rate. What I'm starting to become allergic to is yield maintenance and defeasance prepay. So we're trying to avoid that at all costs. Unfortunately, the types of assets, as we've been getting better quality stuff, the lenders are, there's a lot more options for people that are going to loan on something nicer than, like, say, a 70s kind of value add deal. Fannie and Freddie or a bank loan is probably where you're going to go for something like that, where you get a nice, pretty building that's 2-3 years old. A life insurance company would do that. And there's a lot more ability to negotiate flexible exits and prepays. So if anyone doesn't take anything else from this conversation, certainly make sure you pay attention to your prepayment penalties and the loans you put on these deals, because that can come back and bite you. And, kind of one of the things that Paul Peoples, I heard it from Paul, I'll give him credit. One of the things that, the people that go buy these deals, especially like your first deal or your second deal, you go buy a 50-unit deal or 100-unit deal and think you're going to own it for the rest of your life because it's so great because you've been doing single family. But people own apartments in dog years, right? So every year of real life feels like 7. And the smaller and older the apartment is, the more true that statement is, because this is tougher to run and operate, because usually when you get into these deals, one or two things are going to happen. Either you hate it, you're like, man, this sucks, I don't want to do this, let me sell it and get rid of it. Or you love it, you're like, man, I can't wait to sell the small deal, do a bigger deal and scale up. But at the end of the day, you're likely not going to own this forever. And if you syndicate or you raise capital from other people, forever is not a good hold period. Usually those people want to get a return on their money as well as a return of their money, kind of in that intermediate term, that 3 to 5 to maybe 7 year kind of time horizon. You say, I'm just going to own it forever. Most people don't like that, and they kind of want to move on to the next thing, especially if you're having 50 or 100 unrelated investors kind of pull the capital with you to buy the deal.
Yeah, that's one of the biggest things. I do multifamily financing here in San Diego, and people are always so attracted to the lowest fees and the lowest rate. And I'm like, that is not, you got to look at the whole enchilada, because you never know. 5 years is a long time. 7 years is a long time. You don't know what you're going to do. You want more cash to buy another deal. You need to sell, whatever the case may be. It's like, you need that flexibility. So we're lucky here in California, at least, that the financing is pretty good. I mean, we've got a lot of options, but a prepay is like the one thing I feel like people can't quite wrap their head around. And anytime they've gotten yield maintenance, I feel like I haven't had one client that has not regretted it.
Yeah,
so.
For sure. And I know we're of the age where, it's been a declining interest rate environment for the last 40 years, really, since the early 80s. But I mean, now you talk to the guys that are in their 60s or 70s doing it, and they were loving it the first time they saw a single digit on their interest rate. It wasn't double digits, and it was a tough environment back then. But for sure, I think optionality and flexibility is certainly critical, especially if you're pooling money from other people and doing a syndication. Because having that ability to exit it, and if you want to fix it, maybe think about doing a 7-year loan instead of a 10 or a 12-year loan.
I say, yeah.
Maybe buying down your yield maintenance to 7 years or 5 years versus having it go out 10 years, and I think that's probably the better trade, and give you a little bit of optionality. So if you do have to exit, you're not quite as stuck as we've been in the past. So I know that lesson firsthand.
For sure. And I always say, if you think you're going to hold it long term, I'd go 7 versus 10, because it's long enough to get you through a cycle. at least too. So you don't want to feel like you're caught in a market where you can't get a loan or things are down or whatever. If that's your worry, then 7 years kind of a happy medium. If 5 seems too short, 10's kind of long, go with a 7. I kind of want to shift gears a little bit and just ask about, I know that you raise money and syndicate deals. If someone's looking to invest passively, what kind of criteria do you think that they should be looking for?
Yeah, I do that as well. I'm kind of a binary person. I either like to have risk on my money or risk off my money. So it's generally cash or invest in real estate. In my case, I don't really mess with the stock market too much, kind of a small percentage. So I also invest passively from time to time. Unfortunately, I invested in some oil and gas deals, which sounded good at the time and maybe not so good at the end. But when I'm doing that, or on the other end as a sponsor, we talk to investors, every day of my life pretty much. And, the first and foremost, I think, people invest with people they know, like, and trust. That's kind of at the end of the day, a lot of people that invest with me, they're all smart people, all, accredited investors, so all generally rich in the grand scheme of things. But, they don't know, like, or trust me, they're not going to give me the money. So that's kind of scary because sometimes they get these gut feels and I don't think they really understand what they're investing in, but I think, a lot of this business, and I do this on the opposite end. When I'm investing in other people, maybe I don't pay attention to all the details in the deal. I just like this person. I trust that person. So I'm going to invest with the kind of think of it like you invest in the jockey more than the horse. So the sponsor of the deal, the track record, the experience, the knowledge of the market, the knowledge of the asset class you're investing in. I think that's the first and foremost thing that I'm going to look at when I'm investing into a deal. And then, kind of secondarily, are you in the right asset class, the right market? Is the deal structured in a way that is reasonably conservative? Because some of these people, every deal is a little bit different, so if I'm looking at a stabilized deal that has a light value add multifamily property, I'm going to put 3,000 to 5,000 unit capital improvements into it, is a completely different risk profile than a deal that's 40% occupied, 60% vacant in a tough crime area, or different than a ground up construction deal. So if I'm looking at, the 40% occupied deal's got a 16% internal rate of return, and the more stabilized deal's got a 14% internal rate of return, the risk spectrum of those two deals are completely different. So is that extra 2% return worth the additional risk? Maybe, maybe not. But those are things you should think about on a risk adjusted basis. Is that worth the extra potential return? Because, one thing I've learned by doing, 50 something properties now as a principal, every pro forma, every projection I've ever done has always been wrong. Right? I either do better or I do worse. Never do exactly what you think you're going to do. And fortunately, we've done much better in most cases than we've done worse. And part of that's the market. So, that's not all me. But that's something I certainly learned quite a bit along the way. So just kind of focusing on the sponsor track record, then kind of just looking at the deal and, is it layered in with a bunch of risks? Do I have, 75% mortgage, and then I put 10% preferred equity or mezzanine financing behind it. So the total leverage is 85% to make it look similar returns to maybe the deal that's 70% leveraged over here. So those are things that I look at when I'm looking at a deal.
Nice. Quick question for you. So with all this stimulus going on, obviously, I think a lot of people are taking a step back and reevaluating where they're going to put their money. Obviously, I know the saying cash is trash because you're just not getting a return. It seems like a lot of people are moving into whether it's gold, commodities, or real estate. What's your I know I listened to you, but I just want to know what's your kind of projection with all this printing and inflation, multifamily market. Obviously you guys are in the booming market there in Texas, but what do you foresee, or what do you like all your peers around you in the next 5-10 years?
Yeah, I've been, I'm kind of a paranoid libertarian at heart, right? I've been thinking that we're going to see the end of the world for a while. And so I do have a little bit of gold and stuff like that too. And it's just kind of sat there the last year or so. It's finally kind of moved up a little bit, but actually you talked about JP Conklin. I actually interviewed him yesterday. So it's
cool.
Awesome. On our show. So I was asking him similar questions. So, I keep saying like, when's inflation going to happen? And he keeps, kind of his little comments would be something along the lines of, we all been thinking the inflation boogeyman's been around the corner for the last decade and it's just never come out. And the deflationary pressures of kind of the population aging, the baby boomers kind of aging, technology being deflationary. All these things are kind of really fighting. So the Fed printing all the money is fighting the natural deflationary pressures that we're kind of going through. And, we've been at really low interest rates for the better part of 12, 13 years now in the United States. So I don't think his opinion was, and I tend to agree with him, Jay Powell said he's going to keep rates low for at least 2 to 3 more years. And so he probably thinks that's more like 5 to 6 years on the short end of the curve. The Fed funds, and so that means LIBOR and SOFR for kind of the floating indexes. And then 10-year Treasury went from 2% back kind of right before COVID hit, and went all the way down about 50 or 60 basis points. So about 0.5%. Now it's and I haven't looked the last couple of days, but 115 or 120 right now roughly on the 10-year Treasury. So it's kind of doubled from the bottom, and he's kind of saying that he thinks that the Fed's going to probably put a ceiling on that around 150. So just kind of print money and buy the long end of the curve. And then also if you we're not in a vacuum. So people that buy treasuries, we're going to look at the JGB over in Japan, the German Bund, and those are negative yielding.
Yeah.
So if we get to 2%, I mean that's going to be extremely attractive compared to negative 50 basis points. It's 250 basis points higher than what you're going to get over in Germany, for example. So I think that it's going to be a natural kind of flood of people buying the bonds. So I really don't see it going away, and I think the policies, right or wrong, a lot of what the printing of the money the Fed's been doing, and then the stimulus, all this money, if you think about it, like the big, $2.7 trillion bill they did last last year. What did the average family got was like $1,200 for adults and $600. If you add that times 300 million people, it's nowhere near $2.7 trillion. So all this money is just going into the banks, and you're just looking at these. There's not consumer price inflation, but there's certainly asset price inflation with real estate, stock market, things like that. So it's just it's unfortunate because everyone's concerned about the income inequality and the growing wealth gap, and all the policies are doing is doing nothing but exacerbating that gap. And those of us that can buy real assets that produce cash flow and you can lever them, I mean, we're gonna continue to get wealthy, and the people that live in our apartments going to continue to fall further and further behind. So I don't mean to get political, but it just seems like the prescription to the illness we have is the wrong one. It's going to exacerbate those issues.
Yeah. What's your, I know you guys are not self-managing, but I kind of wanted to talk about a lot of people. I think, I hear if you get above this, you should self-manage. If you don't self-manage, because it really takes your eye off the prize. I've heard people say self-managing is, you're better doing that. So what is your kind of take on either or?
Yeah, I mean, I think all things being equal, no one cares about your money more than you do. So I think all things being equal, self-managing is probably the better way in a lot of respects, especially when you get over, a couple thousand units. You have enough scale where you can probably at least break even, if not make a little bit of money on doing that. But we've chosen to be the safe third party. We engage one firm, so they're Value Residential, so they're based in Dallas, but they manage all our stuff in Dallas and Austin, and we're about 6,000 units today. They're about 18,000 units. So it's kind of the next best thing, I think, from like a carrying standpoint. And I'm a banker by profession. My partner Sean's a financial analyst, and we have 10 people in our company, and we manage $1 billion worth of real estate. And if I had all the property management in the house, I'd probably be more like 200 employees with accounting and HR and construction and regional managers and just, all that stuff. And so it's been like a lifestyle or personal decision that, maybe it would be incrementally, marginally a little bit better, but this is good enough. And really, if you're aspiring to be an apartment syndicator, really the way you make money in this business is, you make it two ways. You gotta find money, you gotta find deals, right? So you talk to brokers to source inventory. You got to talk to investors, raise capital, and everything else is kind of noise. It's really important. Like I'm doing 1,300 K1s right now. It's the middle of tax season. So you got to do your K1s. You got to communicate with investors. You got to asset manage right. You got to implement your capital budgets, capital improvement plans, and do all the stuff you got to do. But at the end of the day, the way you get paid is you find deals and find money. So I'm chosen to, kind of outsource the management. And we have internal people that kind of help. I'm responsible for everything, but they have the day-to-day kind of obligation, and just kind of I just deal with the big problems, not so much the small problems anymore. And that's worked well for us. And so, not saying there's a right or wrong. I would agree that all things being equal, you could be vertically integrated. I know people say you just hire a president of the management company, but then, at some point I deal with this like minutia crap that bubbles up to me now. I can only imagine the day-to-day level about some pissed off tenant at one of our properties over whatever will get to me a lot more frequently if it was in-house than not. And that'd be distracting over the greater mission that I see for my company.
I agree. I feel like you said a key thing there is there's just a lot of noise outside of everything. And I would say that property management creates a lot of noise everywhere. So
yeah, it's a problem business, you got, every day is a problem.
Yeah.
Every day, even the best of times is just problems. And I got enough problems. I don't need those types of problems on my radar screen.
Yeah.
Yep, I agree.
No, it's totally. What is your exact role or strength with your company, and like what separates a good owner or a good syndicator from somebody that's just not great?
Yeah. We my partner and I wish it was more intentional, but it turned out to be pretty good partnership. We have very different but complementary skill sets. So, he's like a genius when it comes to like math and analytics and doing spreadsheets. He's actually got a really good sense of negotiation about them and kind of deal sense to them. So we kind of break our two offices. Austin's kind of like the transactional side of our business. So underwriting deals, processing the debt, they do insurance. So anything kind of around buying, selling, and running escrow, that's generally kind of in Austin. Up in Dallas, investor relations, so kind of the face of the company to the investors, asset management, all the administrative stuff. Unfortunately, I do all the tax returns up here. So kind of anything with the money of the investors or asset management of the deals, that's kind of handled up here. And then we kind of split our duties on sourcing inventory, new products, stuff like that. So I have certain relationships. He has certain relationships. So we all have, we share them, but he's got deeper connections with certain guys, and I have deeper connections with different brokers up here. So we kind of split that. So that's been good. We try not to cross over and get in each other's business too often. I can kind of do what he does, and he can sort of do what I do, but we just wouldn't be as effective if kind of staying in our own lane. So by kind of partnering up together, 1 + 1 doesn't equal 2, it probably equals 3 or 4 in our case, an ability for like the output of work we can do just by doubling down on our strengths. So that's something I would certainly suggest if you're going to be in a partnership. As far as what separates the better owners from the other ones, there's many things, but one avenue I'll say, especially when you're finding deals, from that aspect of it, these deals are largely controlled by brokers. So just making sure you have deep relationships and established relationships with these brokers are real key. So what I've seen a lot of kind of younger people, I think, that are younger in the business, as far as maybe not younger in age, but kind of younger in the business, make some mistakes where they're like, their focus is diverted. So they just want to find a good deal. They don't care what market it's in. So they'll buy a deal in Texas, and they'll go buy a deal in Missouri, and then go buy a deal in Georgia, and then a deal in, wherever, Iowa. And then they're just kind of bouncing all over the country. And they go into these smaller secondary markets. So there's not necessarily anything wrong with that, but it's really hard to do, to manage all the assets when I have it in 2 separate markets and they're really close to each other. It's hard for me to do that right now. I can only imagine how hard it is if you don't know what you're doing because you're relatively inexperienced and you got 4 different properties at 4 different sites, or maybe 2 or 3 different management companies on top of that. It's really kind of scattered. And then worse than that, if you go buy a deal, say in Topeka, Kansas, there's only so many apartments in Topeka, Kansas. And so if you do this business right, the brokers control the deal. So if I do a good job, I buy that deal, I do everything I say I'm going to do, and I get really good marks from that broker, there's not a next deal right behind it to go monetize that goodwill I just created by doing the first transaction. Or if you buy like in San Diego, or you buy in Texas, Dallas, or Atlanta, some of these markets have got hundreds and hundreds of thousands of apartment units. There's a lot of opportunity. So these relationships I built, get monetized over and over and over again. A good example was, I said I closed the deal yesterday. That was the 9th transaction I did with this one broker, right? Wow. So I built that goodwill up 4 or 5 years ago, and then I just monetized it over and over and over again. So when there's a deal, I get that call, and that's what I can do in Dallas I couldn't do in Topeka, Kansas. So I think that's a mistake I've seen some people make. If you really want to be serious about this business and grow into a company, I'd focus on a market or two and make sure I'd probably say to have at least 1 million people in the MSA for the markets that you're focusing on, so you can kind of repeat and monetize that relationship over and over again.
That's a good point. I mean, are you seeing that you're competing with several other people on most of your deals?
Yeah, so it depends. I mean, this one was just us, but it was kind of a special situation. It was the second time we bought from that same seller as well. And,
oh, cool.
But yeah. I mean, there's very few deals that are like that deal where you're truly off market. Even off market deals are like, let's go to a handful of people. So I'm fortunate that I'm generally speaking in that top. I make the top 5 or the top 10 or whatever it is. I'm making that list more than I'm not on the types of deals I want to buy. But yeah, it's like a knife fight. I mean, it's very competitive. It's very, it's a difficult environment to try to win deals if you're seasoned and, have a good reputation. If you're new, it's, that much harder to try to get some of these deals. But, everyone starts with 0. So you got to kind of work at it and be persistent and grow into it. And eventually you get that first deal done, your credibility goes through the roof when you actually do it. Up until then, it's just kind of all academic and no one really believes you that you can actually do the deal. So that's, but yeah, it's competitive. And I don't think that's just exclusive to 2 markets I'm in. I'm pretty sure that's
everywhere.
Major markets across the country. With maybe San Francisco right now, no one wants to buy it. I don't know if anyone wants to sell right now in San Francisco because they don't want to take that kind of haircut because I'm sure everyone's thinking it's a temporary situation. But if you're in Phoenix or you're in Atlanta or Charlotte or something like that, I'm sure it's just as competitive as Dallas.
Well, that recent deal you did is definitely a testament to your relationships because, like you said, they don't come along often. But that's just an example of what someone can do if they build the right relationships and the right reputation.
And that deal, so I'll give you just a couple more talking points on that deal. We bought a deal for that same seller 4 years ago. With this property we bought in Denton, so it's the 5th property we own in the city of Denton. We just own the deal right across the street. I've been tracking that deal for 4 years. Like ever since we bought the other one, I wanted to buy this deal, so we started tracking it, and then I saw last June or July like a little flyer of upcoming deals from this broker. And that was on there. So 240 units in Denton, Texas. I knew exactly what it was from the photo, even though I said a name. And so I reached out to that broker that we have a good relationship. And I was like, when that deal comes out, that's my deal. I want to buy it. So we started kind of working on it preemptively. And then check in every month on it. Never actually saw it get blasted out. Never actually, did the coming soon or the marketing. So I talked to the broker around November of last year. I'm like, what the hell ever happened to this deal? And he's like, like they had a dip in occupancy. And so he reaches out to him. Well, it turns out they had a dip in occupancy. So they decided to not sell it. They're just going to refinance it. And they just started the application. And then, so we were able to stop the refi train because they were literally in the process of it. And so we ended up putting the offer and getting it done. And the broker would have lost his listing and he wouldn't have been paid if we didn't come in. And he didn't think about it, but I'm like top of mind because I talk to him every week, if not multiple times a week. I'm talking to the same guys over and over again. And I just asked about those deals. I'm constantly like throwing ideas out. And if I didn't do it, he wouldn't have had that listing and they would have refinanced it. And that's kind of the testament of being, persistent is, a key trait to be successful in this business.
Yeah, it's helpful too that, he's helped you out and sold you some great deals and you were able to help him out and get him a commission on that listing too.
Yeah. On that note, I was going to ask you
tracking it and being persistent.
Yeah.
I was going to ask you on that note, I think because a lot of people don't really understand, they think maybe deals just float on your desk because, you're the king of the mountain, right, in your town. How often and how many brokers are you probably talking to on a day or a week?
Yeah, I mean, it's every day for sure. We're talking to one or another. I mean, it's a rare day I don't have a conversation with one of them. And there's probably 7 or 8 shops in town that I really kind of focus on. There's a couple more than that in general. Then within these shops, there's kind of hierarchies, and then you get your broker that you kind of tend to be a little bit more kind of your main point of contact, even if they have multiple guys or gals in the group. And so yeah, and then we have 2 markets, so the Austin's a little smaller, but there's probably 12 11, 12 brokers that are really kind of my key relationships. And, some of them I talk to a little bit more often than the other ones. But yeah, every day, if not multiple brokers a day. And if I find I'm gone 2 or 3 weeks without talking to one of them, I'm finding a reason to call them and check in and talk about whatever and see what's going on. So it's a continual thing. If you want to buy and scale, that's kind of what you need to do. That's hard too when you're starting out, because you're going to get a deal, then it takes everything you need to do. Once you've been hunting, you work, finally get the deal awarded to you. Then you're like, okay, now I got to do all this work and raise the money and get the loan and process it and put all the legal stuff together. So you kind of stop prospecting and you kind of just focus on working on it. And then when you close that deal, then all of a sudden you got to work again, then you got to start over and you don't have the inertia. So once we get that used to be me too. And so now we kind of got big enough and got enough scale where we're just perpetually trying to find, new deals, just constantly always. My goal is to be perpetually in escrow. I'm always want to be buying something, perpetually, because sometimes it takes 2-3 months while you're in escrow to actually from start to finish. So I want to have the next thing lined up before that one kind of closes, so I kind of roll right into the next one.
Well, and what would you say not to do? Because I think the other thing is when you're starting, there's this like fine line between bugging a broker and wasting his time and then also trying to build that relationship. You kind of, what I found is you build that relationship through, like you said, performing, through closing an actual deal. And they're like, okay, these people are real. Now we can kind of start building. What would you say some of the not to do's are?
Yeah, for sure. Yeah, that's the fine line you walk. You want to be in their space. You want to be in top of mind for them, but you don't want to be annoying at the same time. And so that's the fine line you have to walk. And when you're starting out, they don't know who you are. If you're just all over them, that's probably not the best approach. A couple of thoughts are really, I think when you're starting out, you need to be direct and honest. So, hey, this is what I have. This is where I'm at in my life. This is what I want to accomplish. So I think being first and foremost, being very self-aware of what you have and what you bring to the table. And, then making sure that you're educated enough and, kind of like, it's like a puzzle when you do one of these deals, you got a lot of pieces and when they all kind of come together, there's a clear picture and you can do the deal. So you got to get your debt, you got to get your equity, you got to be able to qualify for the mortgage. You got to be able to front the pursuit costs. So, when we're buying a $10 million deal, you're probably putting up 100 or 200,000 of earnest money. You're buying a $50 million deal, you're probably putting up $1 million worth of earnest money. So if you don't have that, how do you then get someone else to, front that money for you? Co-sponsoring has been a thing that's been pretty popular the last couple of years, when there's a lot of syndication clubs and groups that kind of people pull together and they meet each other through these clubs, and been able to do a lot bigger deals pretty quickly kind of out of the gate. It's impressive to see a lot of these kind of newer people coming in. And we bought a $4 million deal and had to raise $1.2 million, and I didn't know how the hell we were going to do that. Now people are coming out of the gate seeing guys like me kind of go ahead of them, and then they're seeing that you can do a $10 or $15 million deal on your first or second deal. And that's just kind of mind blowing to me, to see kind of out of the gate some of these groups, the size of some of these deals these groups are doing. So just thinking about all the stuff that you have. And then I think, maybe a couple of tips is, you need to get on all the brokers list in the markets that you want to focus on. This is not a business, I know last 11 months aside, this is not a business you can do from your home or your office. You got to get out, you got to get to know people, tour properties, kick the tires. So if you live in San Diego, you want to buy in Dallas, you got to get on an airplane, you got to come to Dallas, you got to tour these deals. A tip I've been giving out here lately, I think one of the better things to do is, if you're scheduling a tour, maybe be a little strategic about it. Maybe schedule a tour at like 11 a.m. in the morning. And then, when you're done with it, it's naturally lunchtime. And you could go to the broker and say, hey, I don't have lunch plans. You want to go down the street and grab a bite to eat? Maybe that works. Maybe that doesn't. But if they say, okay, and they go have lunch with you, 45 minutes to an hour of time, just kind of one-on-one with that broker. And people do business where they know, like, and trust. And that's a good way to build a rapport. And these little soft edges, these little soft skills go an extremely long way. And it's people, everyone's got money. Everyone can underwrite a deal. The debt's just similar. I mean, there's certain advantages for being big, but a lot of it is about the relationship. And if they like you, they're going to go for bat for you, or they're going to give you that little bit of information that you might need to get your offer right. And, when I'm looking at these deals, I'm talking to a broker, I'm thinking either I want to have the first call if it's an off-market deal, I want to have the last call if it's a marketed deal. I'm always working my way to get in that position where you get that little bit of information, because it's an imperfect market and it's not like a stock. I mean, there's a lot of information you can find out about this deal that maybe the next person doesn't. And then you can, win that deal because of that unfair advantage you have.
Did you have a mentor, or do you have one?
Not
now?
a formal one, right? I never was in a group. I have lots of mentors through both my banking career and then, kind of coming out, just people I observed and talked to and kind of did. But I never had it. I got my educations by doing loan after loan after loan and just kind of figuring it out. It would have been a lot easier if I could just paid someone $20,000 and taught me everything I needed to know versus spending a decade of my life trying to figure all this stuff out a little bit at a time.
What do you think, what would be your biggest piece of advice for somebody that maybe they're not going to syndicate, but they're listening to this, they're going to buy their first 4-plex SFR or 10-unit building, that you would give from your 30,000 foot view?
Yeah, I mean, I think if you just want to own and kind of be like an owner operator of smaller stuff, which I used to be, I think that's certainly fine. I always think about too, if, I stopped at 16 houses in 2013 or something like that, I probably would have had, 1,000 houses and owned them all 100% myself. If I just kind of would have kept going down that, would have to scale that business up and get employees and stuff. And maybe I would have been about the same place as I was going the route I did. I don't really have regret. So I don't know if there's not a right or wrong answer to any of this stuff, to kind of what fits you along the way. So I guess kind of really what's your objective, and if you're wanting to scale and do it, the multifamily is a lot easier way to scale just because of the size of these things. Management's a hell of a lot easier on an apartment building. You got 100 units, 200 units in one location versus scattered sites all over the city. But I think that makes sense. I mean, a lot of people I get that question maybe in a different form, like what's the advice to break into the business?
Yeah.
If you're, inexperienced, I kind of think of it like from two perspectives. One, if I'm 23 years old right out of college, it's a different thing if you don't have any money versus I'm 45, an engineer, and just want to change my career. So if I'm young and I don't have any money, I want to get in the business, I really found three kind of avenues where I've seen a lot of people kind of come out of that have been kind of successful. One of them is kind of what I did. You work for a bank. So get in the credit department, learn how to underwrite these commercial real estate loans and get on the loan production side. You get to see deal after deal after deal. And if you think about it, the largest part of the capital stack, you got your debt, you got your equity. Your debt's, usually 70, 75% of the capital stack. So that's the biggest part. So if you understand that, you're understanding a really key components, how these deals are put together. The next one, I've seen a lot of people either become like an analyst and then a junior broker at a commercial investment sales shop, Marcus and Millichap or CBRE or something like that. So I've seen a lot of those brokers then transition, and you get to, underwrite deal after deal after deal, and you get real on the ground analysis and kind of see these deals, and there's a lot of repetition. And then finally, probably the easiest way out of all of them is really other people that go work at a private equity shop. It's maybe a little bit bigger, more institutionalized version of what my company is. And they just kind of put these deals together and work with sponsors, work with brokers, and kind of put them together. I think the way I came out of those three is probably the hardest, just because as a banker, it's ingrained in you to be conservative. So it's kind of hard to break that mentality and take risk, which, there's a lot of risk in it. So, that's what I would say if you come out of college. If you're 40 years old, 45 years old, and you just kind of want to change your career from being a salesperson or whatever your professional career is, you got a little bit of money. I think the mentoring club is a good avenue. There's a lot of them out there, so I would pay attention, and I don't think they're all created equal, So I think some of them a lot of them have pretty good information, but some of them that have more than the information, the better ones, and that I've observed, have like an ecosystem. They have all those things I mentioned where you got a lot of people in there that you can raise capital from, you can find potential co-sponsors from, you can partner up and do deals. You can get people to help sign on your mortgage to qualify if you don't have the net worth. You can find all the vendors, the management company, the mortgage brokers, the lawyer, et cetera. All that's kind of in one location, one room. And it's just your job to then kind of put all the pieces together. They're not going to give everything to you, but they facilitate that environment where you can kind of make those relationships and grow. And I've seen, you know, dozens and dozens and dozens of people make millions of dollars by joining, you know, various mentoring clubs. So like I said, it'd be a lot easier if I, instead of going to college and working for all these years, if I just could have paid $20,000 and got all that information, would have been a lot easier way about it.
Yeah, I think there's a lot of things that are easier about that ecosystem. Is just a lot of like-minded individuals and people pulling together their relationships. There's a lot of benefits to it, and it definitely seems to be getting more popular, and I can certainly see why. And it's really cool to be able to find a community of like-minded people, because otherwise it's like finding a needle in a haystack.
That's right. And that's when I raise money, it's a lot easier if you're coming to me and you already have two different rich investors, and one of them is just a traditional stock market investor, don't know anything about commercial real estate or multifamily. And you know, if I'm trying to convert them, you know, it's a much harder sell than if I met someone at an investment club that got, you know, some base level education. They also have the same amount of money. They already believe in real estate. They already understand the tax advantages. They already are kind of, you know, they're interested in it. Now they just got to believe in me and believe in the deal. If it's just some random, my rich uncle, I then got to convince them, you know, why me, why this deal, why multifamily, the tax advantages, what's a 506C or 506B raise. This is a lot more uphill battle. So kind of going fishing in a pond that's stocked with the people that already understand it. It's a lot easier way to convert that investor. So I've done both in my career, and that's certainly, I gravitate towards that. Or like you guys have your podcast. I mean, same with me. A lot of people reach out. They've already listened to me for, you know, hours and hours droning on about multifamily. So either they're into it or they're not. And if they're, you know, if they listen to, you know, many episodes, they're into it. So they're a lot warmer lead. I'm kind of like a magnet, attracting people that are interested in what I have to say. So those are people I want to have conversations with versus just some random rich guy who's kind of cold off the street.
Well, isn't that so cool too with the podcast, like you say, because people call you, you have no idea who they are, and they feel like they know you because they've listened to you for hours and hours and hours.
It's a really good tool. It really is. Yeah.
Yeah, no, that's great. And like you said, they have a relationship with me, even though I never met them. It's a weird thing, especially doing it enough. I remember I went to dinner with my wife and her family, and then we're just sitting at a table and someone comes over and says, "Oh, you Michael Becker?" And it's going to sound like a little meet celebrity, and my wife is all embarrassed and in front of her parents. So it's kind of interesting, but it's cool when it works, you know.
No.
Absolutely.
So we always ask one question to end, and then we'll ask you how people can find you. So what's your definition of generational wealth?
Oh, that's a good question. You know, I mean, I think we're probably pretty close to that in my life. I mean, my mother was a school secretary. My father was fix appliances for a living. So, you know, certainly we weren't poor, but we didn't come from, you know, a silver spoon or anything in my mouth. And to accomplish what we've been able to accomplish in a relatively short period of time, it's been pretty amazing. I mean, from the time I bought my first little rent house to today, I don't even know how many multiples my net worth is from that moment in time. And so now, you know, I got two kids. I got a 9 and 11-year-old. So I'm trying to make sure, one, we don't screw them up too bad, and they're, you know, productive members of society. And then maybe one of the two of them want to get into the business and kind of take it over and grow it from there. So I think that would be, to me, that'd be personally satisfying if one of them would want to be in the business. I don't know if that's going to be the case or not the case. And, you know, certainly if I didn't know ever deals the rest of my life, what we own could just regenerate. And that's really cool about the asset class I've chosen, that is, you know, a residual perpetual thing that keeps going up in value, and the cash flow it spits off, if done well, will continue to grow in size every month, and it's recurring and regenerates over and over and over again. So I think that is, you know, certainly, I don't know if that answers your question or not. That would be something that, you know, these are really durable and perpetual assets if done right in the markets. And you gotta pay attention, because, you know, if you thought that in 1960 and you're in Detroit and then half the population moved out, it might be not quite as good. So maybe you need to pay attention to maybe move out of Detroit and come to Dallas in the 1960s, and then you'd have been doing just fine, or Los Angeles or whatever. And but yeah, I think it's a great business, and whether you're active or you're passive or whatever, I would at least encourage you to at least get some level of allocation into the space. I think the demographic wins, and the government wants to encourage affordable housing. Demographics are in our favor, population growth. long as you're in a market that's got in-migration and jobs in migration, you got a lot of wins at your back. So I think you can have, on a risk-adjusted basis, some pretty healthy returns. And the tax advantages are much better than almost any other investment out there.
Yeah. What's the best way for people to learn more about you or find you?
Yeah, I'll give 2 resources, really. So I think the thing I'm most excited about is the new show. It's called the Multifamily Investing Show with Michael Becker. So you can find that on. So video show is in a studio, pretty highly produced. So we're getting some pretty top level guests, I feel in. So you can find that on YouTube. It's probably the best way, or it's on iTunes or Stitcher or Apple Podcasts, wherever you probably hear my voice. You can just type the show in. Our URL is www.multifamilyinvestingshow.com, or the company I run is SPI Advisory. So our website's www.spiadvisory.com. There's a contact us form. You fill it out, and always happy to send out information about what we do.
Awesome. Appreciate the time. Love the show. Lots of great information, and hopefully one day we can do this again.
Yeah, nice to see you guys. Thanks so much.
Okay, thank you.
Bye.
Okay, bye.